Blackstone, BX, one of the world's largest and most powerful alternative asset managers, has defaulted on a $562.5 million loan secured by a portfolio of secondary European properties. This shocking and alarming news indicates that Blackstone, which manages over $1 trillion in assets for institutional and individual investors, is facing serious financial difficulties and risks. It also raises questions about the health and stability of the global financial system, which relies heavily on Blackstone and other similar firms for liquidity and credit. Come with us as we analyze what went wrong for Blackstone. Blackstone, one of the giants in the corporate world, defaulted on a $38 million mortgage for a Manhattan office tower over a year ago. The New York Post reported this, highlighting the severity of the situation. Now, this debt is up for sale at a staggering 50% discount, sending shockwaves through the financial realm. It's crucial to understand that even colossal corporations like Blackstone are not immune to financial problems. As history teaches us with examples like Enron, being a business giant doesn't guarantee perpetual success. Corporations rise and fall, and this case serves as a reminder that no entity is invincible. Interestingly, some were surprised that Blackstone, known for its investment prowess, had a mortgage in the first place. The reality is that even financial giants utilize borrowed funds to leverage their investments and maximize returns. In this instance, Blackstone walked away from a prime location, possibly their headquarters in Manhattan, leading to the failure of the commercial mortgage-backed securities, CMBS. The CMBS, essentially a bundle of mortgages sold to investors, has now become a concern. Initially valued at $38 million, the mortgage is currently on the market for $150 million, marking a 51% discount. This steep reduction reflects the struggles in the real estate market, especially in the commercial sector, where many are defaulting on loans. What's noteworthy is that these distressed debts are flooding the market, and they are selling at alarming discounts. The domino effect is apparent. When someone defaults on a loan, it adversely affects various aspects of the financial system. Pensions, often tied to these investments, bear the brunt, further exacerbating the fragile state of pensions. Now let's bring attention to the broader context. The Blackstone default is not an isolated incident. It indicates a larger trend in the real estate market. Office buildings, like the 26-story Art Deco-style tower in question, are struggling to attract tenants and meet mortgage obligations. As more of these distressed debts emerge, they are being sold for pennies on the dollar, signaling a worsening situation. The sale of Blackstone's defaulted loan is a spectacle, with JL, Jones Lang LaSalle, orchestrating the process. The discounted price of $150 million raises questions about the confidence in the market's ability to absorb such distressed assets. It's a matter of speculation whether this distressed debt will sell for the listed amount or face further depreciation. The government and regulators are closely monitoring these developments, recognizing the potential for a cascading effect on CMBS. The fear is palpable. If such high-profile defaults become more common, it could trigger panic in the market. This echoes past instances where underhanded deals and interventions sought to prevent a complete breakdown. In essence, this Blackstone default serves as a measure of the health of the real estate market. As more distressed debts hit the market, their sale prices will reveal the true extent of the market stability. Dry powder, or readily available funds, becomes essential in preparing for a real estate downturn as savvy investors look for opportunities amid the chaos. The government's role in managing such situations, the impact on pensions and the broader implications for the economy are all elements that demand attention. Blackstone's default is not an isolated incident, but a symptom of a broader problem affecting the entire banking sector and the economy. The banking sector, which has been struggling to recover from the global financial crisis of 2007-09, is facing a new wave of challenges and threats. For instance, the Federal Reserve and other central banks have kept the interest rates near zero for over a decade to stimulate the economy and the credit market. However, this has also reduced the profitability and attractiveness of the traditional banking business, which relies on the spread between the interest earned on loans and the interest paid on deposits. The low interest rates have also encouraged excessive borrowing and lending, creating a debt bubble that may burst at any time. The banking sector has also been facing high costs, as it has had to comply with more stringent and complex regulations to prevent another financial crisis and protect consumers. These regulations have increased the capital and liquidity requirements, the risk and leverage limits, the disclosure and reporting obligations, and the oversight and enforcement actions for the banks. The banking sector has also had to invest in more technology and security to cope with digital disruptions and cyber threats. Additionally, the banking sector has been losing customers because it has been unable to meet their needs and expectations, especially in the wake of the pandemic. The banking sector has been criticized for its poor customer service, lack of transparency, and unfair practices, such as closing accounts without notice, freezing withdrawals, and raising fees. These challenges and threats have eroded the bank's financial condition and market value, making them more vulnerable and exposed to shocks and defaults. Blackstone's default is one of the many examples of the bank's troubles, which may have severe consequences for the economy and society. Blackstone's default means the loss of a large amount of money and assets, which may affect its liquidity and solvency. The default also means damage to its reputation and brand, which may affect its market access and customer loyalty. Due to this default, Blackstone's legal liability and regulatory scrutiny may increase, affecting its operational freedom and strategic flexibility. It may also trigger a domino effect, as it may lead to the default of other loans and bonds that are linked or related to Blackstone's portfolio. For the banking sector, Blackstone's default means an increase in credit risk and credit losses for the banking sector, which may affect its profitability and stability. It also means a decrease in confidence and trust in the banking sector, which may affect its funding and lending. Blackstone's default may also spark a contagion effect, as it may spread to other banks and markets that are connected or correlated to Blackstone's activities. Generally, Blackstone's default means the reduction of the credit availability and affordability for the economy and society, which may affect their growth and development. Blackstone's default also means the disruption of the financial intermediation and the financial inclusion for the economy and the society, which may affect their efficiency and equity. Blackstone's default also means the deterioration of the financial stability and the financial security of the economy and society, which may affect their resilience and well-being. In the wake of Blackstone's recent default on one of its flagship properties, 1740 Broadway, the real estate market is buzzing with concerns about the potential repercussions for both commercial and residential sectors. This incident sheds light on the complex dynamics at play in the world of real estate investment and the broader economic implications for the United States. To understand the gravity of the situation, we must understand the background. The skyscraper, located in a prime area, has been steadily losing value since 2014 when the mortgage originated. The appraisal back then pegged it at a substantial $605 million. Fast forward to the present, and Blackstone is attempting to sell the debt on this property for a mere $150 million, a striking 25% of its original value. This significant decline raises questions about the sustainability of real estate investments, especially in the aftermath of the 2008 financial crisis. The idea of perpetual real estate growth has been challenged as market dynamics evolve. The post-2008 era saw the Federal Reserve monetizing debt to stabilize the economy. However, the anticipated inflationary pressures did not materialize as expected. The intricacies lie in the velocity of money and the lack of significant transactions, resulting in a muted impact on inflation. Moreover, the commercial real estate landscape has undergone substantial changes. Over the past decade, the surge in office space and multifamily home constructions has created a competitive environment. A parallel can be drawn to the pre-2008 period when the housing market peaked. Similarly, the current boom in office buildings and multifamily units could be a precursor to a correction. The 1740 Broadway property serves as a microcosm of larger market trends. The attempt to sell the debt at a massive discount indicates the challenges Blackstone faces in recovering its investment. The real estate market's response to this situation could reverberate through various sectors, affecting investors, developers, and even potential home buyers. Reports suggest that Blackstone's EQ, a U.S. office portfolio company, overpaid by at least $100 million for the building. This raises concerns about the due diligence process and the reliability of valuations, emphasizing the importance of trusted advisors with genuine expertise. Blackstone's default is a cautionary tale for those navigating the real estate landscape. The residential market may not be immune to these shifts, and investors need to be discerning in their decisions. The story of 1740 Broadway reflects the challenges and uncertainties in the ever-evolving real estate arena, urging industry participants to approach investments with a keen understanding of market dynamics and potential risks. Blackstone's default is not inevitable, but it is possible and probable given the current trends and conditions. Therefore, Blackstone and the banking sector must prepare and respond to this scenario by adopting appropriate policy recommendations. Blackstone should reform and restructure its portfolio and business by addressing its financial problems, enhancing its risk management and compliance, and restoring its credibility and confidence. It should also engage and cooperate with its creditors and regulators by providing clear and transparent information and explanations about its default, offering reasonable and supportive compensation and benefits to the affected parties, and complying with the relevant laws and regulations. The banking sector should also coordinate and collaborate with each other and with other stakeholders by sharing information and knowledge about the credit market, managing the risks and the challenges of the credit market, and pursuing the interests and goals of the credit market. Blackstone's default is shocking and alarming news, as it indicates that Blackstone, one of the largest and most powerful alternative asset managers in the world, is facing serious financial difficulties and risks. It also raises questions about the health and stability of the global financial system, which relies heavily on Blackstone and other similar firms for liquidity and credit. Blackstone's default is not an isolated incident, but a symptom of a deeper and broader problem that affects the entire banking sector and the economy. Blackstone's default is a wake-up call for the US and the world to pay more attention and take more action on the credit market and the financial system.